Okay, welcome back to Accounting 401. In this YouTube video, we are going to discuss Chapter 8, Individual Income Tax Computations and Tax Credit. As always, I'd advise you to read the learning objectives at the beginning and end of the chapter and the storyline because it gives it some, reflects real world situations about what the theoretical part of the chapter contains. All right, there's two ways to determine how much tax an individual owes. You can use the tax table, or you can use the tax rate schedule. So tax rate schedule appears in the appendix at the end of the book, and the tax schedules, you'd have to go on the IRS website. The tax schedules, as published by the IRS, are it's like newspaper paper, and it's, I don't know, 12, maybe 20 pages long. And you just find your filing status and your income bracket, and it breaks it down by $50 increments, I believe, maybe $200 increments. It's been so long since I've used one. If you use software, it's already built into the software. And if you again, you find your taxable income in the left-hand column, you move over the top columns are headed, or down the rows, you find your income in the rows, and I'll get this page after page after page of just numbers. And the left-hand column, row by row by row, is your taxable income. Across the top, you have the 5 various filing statuses, and then you find where your filing status is and your taxable income, where they intersect. That'll show you how much tax is due given that filing status and that taxable income level. The other way to do it is to use the tax rate schedules. That's probably how the software does it. And there's various schedules. Again, the schedules you use are a function of what your filing status is, and then it'll tell you, it'll give you a number that your tax is X number of dollars plus a percentage of the amount over a certain amount. And what they do is each bracket for the different tax rates, they calculate the maximum, and then whatever your marginal tax rate is, it's above that amount, and then you take the percentage of the amount over that threshold. Okay, so again, they start the chapter off with reviewing your 5 statuses there: married, filing, joint, qualifying widow or widower, or also referred to as surviving spouse; married, filing separately, head of household, and single. Okay, so it's very important that you use the proper tax filing status. So you use the right, that'll tell you which table to use, or which column to use if you're using the tax schedule as opposed to the tax rate method. Oh, it just went blank on me. All right. Tax rate schedules. Yes, Appendix C at the end of the book. Notice that the married filing separate schedule is the same as married filing, except that it's cut in half. Okay. You can take a look at the schedule Appendix C at the end of the book, and you'll see these schedules. I don't know why they have them. It's Schedule X, Schedule Y, Schedule Y2. They have them screwy names to them. But again, ignore the name and look at what filing status it is, and then it's a simple mathematical computation. It's tax would be $4,560 plus 20% of the amount over 72,100 or something like that. They give you a computation here, and an example in Exhibit 8.1. Courtney her taxable income is $145,070, and her tax base is her base tax $13,293, and then you find her bracket where that $145,070 falls into, and that would be anything above $86,350. So you subtract her taxable income $145,770, subtract that $86,000 from that, and that is the $58,720. That's what is going to be taxed at her marginal rate, the 24% bracket for the head of household schedule. And you multiply the $58,720 by the 24%, and add that to the 13,293. Okay, and again, the 14,092.80 is from her that's the amount of her tax that is taxed at 24%. That 1,003 would be the earlier brackets, the 10% bracket and the 15% bracket, or whatever it is there. And then you add those two together, and her total tax is 27,386. Okay. Marriage penalty or benefit. There was a quirk in law years ago. They had the filing statuses would sometimes benefit people or penalize people depending on a husband and wife, or a husband and husband, or a wife or wife nowadays, depending on their relative incomes. If both their incomes are high, if their incomes are close, regardless whether they're high or low, it's kind of all right. It breaks out, it falls out in the wash, breaks out even. If one spouse or the other, if there's a large discrepancy between their incomes, one person makes like 220,000, the other person makes 20,000. So when you have the big discrepancies between spouses on their taxable income, that is where this comes into play. So sometimes, rarely, it's better off to have them file married filing separate. Usually it's not, but there are times when you have extremes like that where it happens. So I'll give you an example here of, two wage earners, one wage earner with the same amount, $700,000. And I think later on in the chapter, they'll show us, that if each makes each makes 350 each, and then the other one where the wife makes 700,000, husband doesn't make any, and what the impact would be. So tax of filing jointly, 195, 522 versus, it'd be the same, no problem there. Now, if they file separately, you can see the wife pays 223, husband doesn't pay anything, so she gets penalized by $27,000 more she pays in taxes by filing together when they both make the same. The 5, 9, 23, tax of filing separate. So they would pay more. They got that backwards. A negative amount is they're paying more. That's a penalty, not a benefit. Okay. They even make mistakes in textbooks, especially this one that comes out every year. They keep revising it. So the more you mess with it, the more likely you are to have a mistake. Preferential rates for capital gains and dividends. I did my taxes over the weekend, and let's say I won't be filing until the 15th. Actually, this year, I think the 15th is a Saturday, April 15th. So you have until Monday, the 17th to mail them. But I have some interest in dividend. Well, interest is regular, ordinary income. Dividends, I get preferential treatment. So some of my dividend, I had qualifying dividends and I had non-qualifying dividends. So the non-qualifying gets taxed at my marginal rate. The qualified, I get a preference on them. They get taxed at a lower rate depending on your AGI, okay, or depending on your marginal tax rate. So you got to split the taxable income into the portion that is subject to the preferential rates. That would be capital gains and or dividends, and then compute the tax separately on each type of income and then combine them. Okay, not very difficult. Three-step process there. They give you an example for Courtney, and let's see, she had $700 of tax preference items, $700. So that 15% of the 700 be $105, and her regular income is 144. So her gross taxable income less the qualified dividends, take the 700 out, and then you figure out the tax, then you figure out the tax on the qualified dividends, add them together. No problem. Pretty straightforward. Kiddie tax. This was enacted a couple decades ago. A lot of rich people try to use the tax strategy of assignment of income to avoid taxes. I shouldn't say avoid taxes, and try to put some of the income into their children, which the child will be at a lower tax rate because the only thing they might have is, an odd job here or there, or some passive investment income. So instead of the parents getting taxed at 20 or 30% marginal rate, you put it at the kid at 10%. The trouble with that, not the trouble with it, but Congress shut that strategy down by enacting this kiddie tax and say, the person that owns the investment property is the person that's taxable. The income derived therefrom is taxable. So to shift unearned income to the children of the so-called kiddie tax, the tax laws reduced, curtailed that strategy, and because again, it was a strategy that's pretty much a tax dodge. So the provisions say that apply to a child is if the child is 18 years old or younger at year end, under 18, the child is 18 at year end, but earned income does not exceed half their support, or the child is over 18 but under age 24 and a full-time student. Full-time student is defined as having attended school or some type of schooling, not necessarily college, for a 5-month period in any given year. Okay, full-time 5 months. It's a tax code. What can I tell you? Sometimes there's logic to it, sometimes there's not. So it's their net unearned income gets taxed at the parent's marginal rate rather than at the child's marginal rate. And all that is a mechanism for the IRS to really say, hey, it's the parents generated the ability to buy the asset, the investment asset that generates the income, and therefore it should be taxed to the parents and not the child. Okay, net earned income is the lesser of the child's gross unearned income minus the child's taxable income. Okay, again, we're talking unearned income there, investment income. If the child has a job at Burger King or delivering papers or what have you, that's earned income. That doesn't enter into it, although that will enter into whether they earned enough to contribute to more than half their support. Again, they give an example that should clear it up. The book is really good with their examples. Again, look at the key facts there. Regular rates, and depending on your filing status and the higher the taxable income, the higher bracket you go into. Preferential rates, long-term capital gains, and qualified dividends taxed at either 0%, 15%, or 20%, given your taxable income and your marginal rate on your ordinary income. Kiddie tax, unearned income in excess of $2,200 is taxed at the parent's marginal rate. If the child is under 18 but a full-time student, or under 24 and a full-time student, or 18 but their earned income does not exceed half of their support. So 3 relatively simple rules for the kiddie tax. Alternative minimum tax. Again, this is a action by our elected officials. I hate using that term. They love that term. We call them what they are, politicians. Again, this is in response to the outcry of make sure that the rich pay their fair share. And if you look at the tax research data, they are paying way in excess of their fair share. The top 10% of wage earners are paying 40 to 50% of the income tax collected. So I don't think that's fair. Wish I was up in that bracket, but I'm not. Close, but not. So they come out with this alternative minimum tax. And again, directed at high income tax individuals to make sure that they pay something. Because a lot of these high income tax individuals, how you get to have high income is to generate a lot of income. Usually you have a really, really good paying job or two, and probably have multiple investments to really get a lot of income generated. So if you have a lot of losses, you can offset some of that. Okay, So what the alternative minimum tax does is it disallows certain deductions for people that are for certain items for certain high income individuals. Okay, and they give you the formula there, and actually it cuts in pretty low. I'm surprised how many people actually qualify for that. That it was not intended to cover. So you have the alternative minimum tax formula, and it comes out to a tentative minimum tax, but then there's a safe harbor for other things that then you don't have to pay it. Again, it only kicks into certain circumstances for certain individuals. Okay, so they Exhibit A2 shows you the formula for it. That's being the software. It's also on the forms. It walks you step by step. Just asks you for an amount from this type of income, that type of income, and then you compare certain things. And if so, boom, this amount is going to be subject to tax regardless of your other tax qualifications. In order to compute you have to make some adjustments. And again, it's adding things back like accelerated depreciation. Here's Exhibit A3 has some of the common adjustments. Tax exempt interest from income, interest from private activity bonds, municipal bonds, real property and personal property tax deductions, deducted as itemized deductions. Okay, so deductible for regular tax purposes, subject to 10,000 limitation for state and local tax, but not for AMT purposes. Plus or minus adjustments, depreciation, accelerated depreciation on certain assets, especially rental properties, real estate. Minus adjustments, state income tax refunds. Again, gain or loss on the sale of depreciable assets. So there's the Form 6251, an alternative minimum tax computation. You could spend some time looking at those line by line item. I love how they do it line 1 and then line 2, A through T. Why can't they just number them? And again, it brings money over from if filing Schedule A, that's your itemized deduction. And there's your minimum tax. Continuing on lines 1 through 3. And part 2 is depending on your filing status and your income. Look at that, $518,000. If you're single or had a household, $1,036,800 if you're married, filing joint. So again, you can see that the target audience there is the high wealth individual, high net income. Married, filing separately, $500,000. So again, you're only talking maybe a single digits of the population that have taxable income over $500,000. I would imagine it's even in 5% or less. I used to know these numbers pretty good because I always kept up on them when I teach this in the fall. I think somewhere around the $300,000-$400,000 mark is where the 10% or more of the population falls. So 90% of us make less than $300,000 or $400,000 a year. But there's a lot of us. And that's who they have to, tax the masses. And, if you really got into researching the numbers and all, they could tax the rich people 100%. They could tax every penny they make, and that wouldn't put a dent in the federal deficit because there's not that many people. We have 340 million Americans. Well, let's say half of them pay taxes because the rest are kids, don't have any income. So 150, 160 million people. Out of that, there's only around 1 million millionaires. Okay, so that's less than 1%. It's probably somewhere around 0.75%. My calculator's over on the other table. Yeah. Let me see my phone here. Let's do a quick calculation here. 1 divided by 160. Yeah. 0.6% of the population. So again, very limited access. Although in certain circumstances, some average people can find themselves in a situation where they may be subject to the alternative minimum tax. Okay, major itemized deductions are deductible for both regular and AMT purposes, charitable contributions, home mortgage interest, and gambling losses. Now, again, charitable contributions, the intent is, get back to the basics we talked about in chapter 1. Two things for taxes. We want to raise enough money to fund government operations. Number two, we want to encourage certain behavior among the citizens. Well, charitable contributions is a worthwhile goal according to Congress, and it is, the more you give charity, the less Congress has to do for, feeding the poor, clothing the poor, and helping them out in other ways. A lot of not-for-profits do a lot of good work, and a lot of them get government funding, but a lot of them also get quite a bit of donations. Home mortgage interest expense, again, home ownership is let's say the American dream, so they want to encourage that, so they allow that. Of course, we know that is limited to the interest on the first $1 million borrowed. Now, again, how many people have $1 million homes? You're talking single-digit percentages of Americans. Gambling losses, I don't know why that's in there. The only thing I could think of is that the gambling people have a strong lobbying group, and again, that's a hard itemized deduction to get. Some deductions are deductible for regular tax and AMT purpose, but have different limitations. So they give you an example on 8.5 about some of them. AMT exemption, that's where I said, even though they're looking to go after the high net income individual, there are some times when, due to some what they call outliers in the data, some average folks will be subject to this. Well, they give you an exemption for it. Let's see what it is. Exemption is phased out by 25 cents for every dollar the AMT exceeds the threshold amount. So it applies to the tax base, which would be the income. So there you see the exception, $114,600 for married filing joint, half of that for married filing separate, and then they phase it out at the upper levels of taxable income. Again, not a lot of people does this come into play to. Corporations are also subject to the alternative minimum tax, but this is, of course, an individual taxation. So they talk about the base, they talk about the exemption amount and the rates. So again, you have to be aware of it. I kind of think back when I prepared taxes, if I think myself once or twice, I had things that would trigger it, but then I didn't have to pay it because of the exemption amounts. Again, very rare, not very rare, but chances are you're not going to encounter it a whole lot because it only affects a very small number of people. Additional taxes. Net investment tax. Again, you can just tell by the name that they're going after the high income individuals. So higher income taxpayers are required to pay a 3.8% tax on net investment income. For purposes of the net investment tax, it equals the sum of the gross income from interest, dividends, annuities, royalties, and rents, unless those items are derived in a trade or business, to which the net investment income does not apply. An example would be, if you are a loan merchant or if you are a real estate investor. I, at one time, did have a real estate investment, but I had a day job. There are people I know that's all they do. That's their job. They have 10, 20 or more rental properties. I know one fellow has them in the vicinity of King's College and rents exclusively to King's College students, and that's his job. So it's a trade or business for him. It's not a passive investment activity for him. It's an active. He goes around every day, and in addition to collecting the rents, he's maintaining the property. He's cutting the grass, he's painting, he's cleaning, he's fixing the electrical, fixing the plumbing, whatever else, replacing carpets. So he's actively involved in a trade or business because he has so many properties. No other source of income other than some investment income. Income from a trade or business that is a passive activity or a trade or business of trading financial instruments or commodities. Okay, a broker, stockbroker, commodities broker. Net gain from disposing of property other than property held in a trade or business. Okay, less the allowable deductions that are allocable to items 1, 2, and 3. Again, a provision that more than likely will affect a minute portion of the tax-paying public. And like I said, it's a surcharge on high net worth individuals. And I always come across this, I'm thinking, where's the fairness in this? You're punishing people that are successful, and it's just the 3.8% of whatever money they make is not going to put a drop in the bucket against the national debt. It's just a move by politicians to make it look like they're not letting the millionaires get away without paying any tax. So if I was one of those people, I'd like to be. I wouldn't be happy with that, but I would probably try and get a lawyer and go to the Supreme Court and say, hey, whatever happened to the 14th Amendment, equal protection, equal treatment under the law. This is clearly unfair. It's discretionary. They're picking on rich people. But that's what the public wants from their elected officials. They've got all these other problems, and they're worried about 3.8% of a couple $100 million. When you're talking billions and trillions in the national debt, it's immaterial. Employment and self-employment taxes. Well, Social Security, 15.3%, and there's two components to it. The Social Security tax, everybody refers to as Social Security. There's actually two components to it. One is the old age and survivors disability portion, which is the 6.2%, and then there's the Medicare tax of 1.545%. Now, I took half of those numbers that are appearing there on page 814 because the employee pays for Social Security and Medicare, and the employer has to match it. Okay, that's where you get up with the 15.3%. Okay. 12.4% is the Social Security, and that's split between the employer and employee, so that half of that would be 6.2. The Medicare tax is 2.9%, and again, that's split between employer and employee, so half of that would be 1.45 on both the employer and the employee. Now, these taxes are combined, and they call it FICA, Federal Insurance Contribution Act. And there's a limit on the Social Security. That tax is only applicable to the first in 2021. It's only the first $142,800 is subject to that tax. The Medicare portion of the tax, there is no cap. If you make $142,800, it's the year 1.45 is subject to the tax. If you make $142,801, that $1 above the limit is also they take a dollar. They take a penny, 1.5 cents, literally out of it. And again, if you're making over $1 million or $2 million or whatever, there is no capitation on the Social Security, on the Medicare portion of the FICA. Okay. Now, if you are self-employed, guess what? You get to pay both parts, both sides, the employee part and the employer part. Now, they give you an adjustment on the bottom of the 1040 for that. Now, you can ignore those amounts, the 142,800, because that is indexed for inflation and it's adjusted every year. It goes up. Now, note that there's an additional Medicare tax of 0.9% over $200,000, or $125 for married filing separate. Okay, $250 for married couples. Okay, again, figuring on attacking the high-income individual, they can afford to pay a little bit more, 0.9% if you're up in those areas. Not a whole lot of money. It's kind of immaterial to you. So they pretty much don't care, and the government doesn't care either because that's not putting up helping at all the deficit Social Security Administration is running up, and they're just going to have to increase the limits and increase the tax rate or somehow decrease benefits. And any politician that does that is going to be elected out of office. So that's not going to happen. Again, you see a lot of, maybe they have to do it on a needs basis. I remember when Ronald Reagan was president, he was collecting Social Security. Joe Biden, he's 80 some years old or close to it. He's collecting Social Security. Does he need it? No, his base salary is $400,000 as president. Plus he has all that additional income that he gets from all the investments he made since he was out of office in the last, between being vice president for Barack Obama and then getting elected in 2020, he made a killing. I don't know how, but I guess a very shrewd investor, huh? Again, they got the key facts there that sums up everything that was written above it. Right underneath the key facts, both employees and employers have to pay the FICA tax, so they give you the split down 6.2% for the employee to 6.2% for the employer. That is for the Social Security portion, and the limit in 2021 was $142,800. It's probably, I think it's 143 something now, but every year it's adjusted upward. And then the 1.45% by the employer on the employee and on the employer. And again, that is on every dollar of income, the last dollar earned. Okay. Employers are required to withhold the 0.9% above the threshold limit for the higher income individuals. Now, the thing you have to watch, if you have a high earning individual that moves from one job to the other, to another job during the year, you have to watch that threshold. That's where the threshold comes into, becomes important for a tax preparer. That if you had somebody that worked somewhere and made $125,000, or let's say $140,000, and then they switched to another job, or let's say they made $150,000 already. They already hit the threshold that exceeded it, so they're not paying any Social Security, and neither is the employer. They're still paying the Medicare though, and they move to a different employer. Well, that new employer doesn't know what they made in the earlier months of the year when they're working at the other place. So you have two things. The employee can go to the employer's payroll office and show them that they're over the threshold and not subject, or you'll get it back as a refund when you file your taxes that you overpaid your your Social Security. Can't pay your you can't overpay Medicare because there is no limit. You pay on the last dollar you earn. So the examples there address that situation. And there we have a situation where Courtney switched jobs and how much does it have to pay because she went over the limit. And then right above example, or right between example, oh, why won't this go up? Come on. Between example 811 and 812 is where they talk about what I just said. Employees who work for multiple employers within calendar year and get total compensation over the base does not exceed with any one employer. How to handle it there. Okay. Self-employment taxes. Social Security, if you're self-employed, you are both employee and employer for FICA tax. So they walk you through how to do it there, and you get a net earnings from self-employment on your Schedule C, and that gets multiplied by 92.35%, which is half of the 7.65%. Social Security and Medicare together, employee added up, it's 15.3%. So think about that. In addition to your income tax rate, we are also taxed an additional 15.3%. So if you're in the 20% bracket, you're actually paying 35%. So they go over 1/3 of your compensation is going to the government. So they walk you through the 5 steps there. They're pretty straightforward. And the forms are the same thing. The software you use, ask your questions, and it'll compute that automatically. And if you will do it by hand with the forms, you just put the number on the line that they're asking, what number they're asking for, and it'll tell you If it's above this amount or below this amount, go to the line here on this form, and it's pretty hard to make a mistake as long as you can read and you know your numbers. Again, they give you another example, another walkthrough there with the steps in case you have multiple employers. Unlike employees who employers withhold tax throughout the year, self-employed for their self-employment obligations through periodic, usually quarterly estimated payments. There is a form called 1040 ES. That's individual 1040 ES estimated payments. It is required to be paid because you don't have withholding. You are self-employed. There is, you're not getting a paycheck where the withholding is taken out and the Social Security is taken out and sent to the IRS or the Social Security Administration. You have to do it. So you have to also, I make quarterly payments myself because I have a lot of income other than what Misericordia pays me. What Misericordia pays me, they have a schedule based on my filing status, how much you make. Here's how much should be withheld. Well, I actually have a little bit extra withheld. You can do that if you go to your employer and ask them to do it. Schedule W-4, I believe it is. I'm not sure on that. And that still doesn't cover my other sources of income. So I have to make quarterly payments. April 15th, June 15th, September 15th, and January 15th. And I have to make sure that I have enough paid in to equal how much tax I paid the previous year, or 90% of the tax I owe this year. Otherwise, I'm subject to underpayment penalties, or any taxpayer would be subject to underpayment penalties. So the estimated payments are one way we can pay taxes. The only way you can pay taxes if you're self-employed. Like I said, other sources of income, my pensions and all that. So I do estimated payments. I made $9,000 in estimated payments for 2022. 4 times I wrote checks for $22.50. Years ago, and it still exists somewhat today, but that has narrowed down. A lot of people that are in business, having employees is expensive because you got to pay 7.65% more than what you're paying them, plus a lot more for other things too, other fringe benefits. It's very expensive to have an employee. All right. So they would rather have people come in and call them independent contractors. And sometimes you do. Okay. You have a insurance agency, and you might have a maintenance guy on staff to do light general maintenance. But when you need something major fixed, like the HVAC system or the heating, ventilating, air conditioning HVAC, electrical system, plumber come in. They're a contractor. They have their own business. They do it day in, day out. You come in, they do what they do. They send you a bill, you pay it. Okay. They have to pay they're self-employed. They have to pay, or they work for a big company, and they have to, they pay their Social Security, and the company pays their Social Security. If it's a employee that you have, or I shouldn't say employee, if it's a person you have, a lot of businesses try to label that person an independent contractor, meaning instead of a W-2, they're going to give the payments they give that person, they're going to report them on a Form 1098 or 1099. I get them mixed up. And they're going to make that person liable for their own Social Security and Medicare tax. So the IRS has clamped down on that 10, 15, 20 years ago. And the big thing is, does that individual, are they controlled by the party that they're doing work for? Do they, there's a lot of tests here listed on page, it's page 110. That's one thing about this book. Page 8-21, employee versus self-employed independent contractor. All kind of tests the IRS has developed and they've made it very difficult for you to have somebody who works exclusively for you be considered or qualify as an independent contractor. I had a client that tried to do that, and we tried to set it up. That he ran horses over here at Pocono Downs and over down in Delaware and New Jersey. and he had helpers, groomsmen and stuff, help around the paddocks and stuff. And I said, make that guy work for somebody else as well. So he is an independent contractor that is offering services, selling his services to you and someone else. If he's just exclusively for the one, there's a very good chance the IRS would come and say that he's not a contractor, he is an employee, and then you got to start paying Social Security tax on and other things, unemployment tax, workman's comp. So all these little things add up where, if you think you're paying somebody $100 a week for 20 hours worth of work, it actually somewhere around $125, $100 to $140 a week with all these add-ons. So to try to avoid that, people will try to have these people treated as a independent contractor. So more control over how, when, and where they perform. Report income expenses on Form 1040 Schedule C. So they pay their part of the Social Security tax or with a deduction. Instead of 15.3, they only pay 12.4. They go a little bit of a break. Yeah, well, no, there's a 2.3, 15, 14, 15.3. So they pay the Social Security, pay the Medicare, but then they get a little bit of an adjustment on the face of their 1040. And, you look at how much time they do. Do they set their own working hours? So they work part-time, work for more than one firm, realize either a profit or loss from their activities, perform work somewhere other than at the employee's premises, and work without frequent oversight, control. Okay, so they next paragraph, several sections, they talk about how to distinguish between an employee and an independent contractor. Okay. Okay, they finish up down on page 823 with Courtney and Grandma. Is it Grandma? Let me see here. Courtney's gross tax. Gross tax minus credits, that would be your withholding, minus prepayments, that would be your quarterly, and that would be your next net tax due or refund if you overpaid. That's okay. You can pay your taxes with withholding from your paycheck if you work for an employer. The estimated payments we talked about, or you can use tax credits to offset your tax. Now, when you file your tax return, if you have a refund coming, you can have that refund credited against next year's taxes, sort of a extra bonus estimated payment, or you can take the refund. I take the refund and I write them a separate check for my estimated payments just to keep things nice and simple and easily understood. Now, the tax software will pick up if you have it credited towards the current year's tax, but there's a chance you could forget to do it. Okay. Now, there's two types of credits: non-refundable credits and refundable credits. A non-refundable credit is a credit that cannot increase a refund. A refundable credit can actually end up with you getting a bigger refund than you are due. It's one of the things one of my big pet peeves, the earned income credit. Don't get me started on it. Personal credit, or the credits, like I said, can be used to reduce. And in fact, credits are more valuable than deductions. Deductions lower your taxable income. Credits lower the tax that has to be paid. So what would you rather? Yes, dollar for dollar reduction in tax owed. Child tax credit. Taxpayers may claim a $2,000 credit for each qualifying children under age 17, under 18 in 2021, or $500 credit for other qualifying dependents. Okay, they may claim an additional $1,000 per child and child tax credit, and separately for 21 additional credit is phased out for taxpayers with AGI above applicable thresholds. That threshold, they didn't tell you there. They will for 2021 in the body of the chapter. But again, that amount is usually indexed for inflation or somewhat adjusted upwards. Again, they're giving middle and lower income people a break upper income people do not get the credit because they theorize they don't need the credit. And anyway, let's tax the rich. Child credit, $200,000 child credit. And again, if you're married filing joint over 400,000, you don't get it. Filing separately, half of that, head of household, half of that, you don't get it. So again, that means 90% of the taxpayers will qualify for it because you're talking some pretty high AGI or taxable income there. AGI, alternative or adjusted gross income. So 4-step process there. Determine excess AGI by subtracting the threshold amount. Divide the excess AGI by 1,000 and round up to the next whole number or multiply that amount. From step 2 by $50, and that's it. This is for people that are in the phase out bracket of how much the credit will be. So the max credit is $2,000, but if you're in the phase out period, if you're above the phase out, you don't get it. If you're in the phase out, you're going to get a percentage of it. And these 4 steps determine how much the credit will be. They give an example there, and then they have a special one for 2021 only, so you can forget that, unless you have to do an amended return for somebody that had a qualifying child or a qualifying relative. So that's a moot point right now, unless you have to file an amended return. Child independent care credit. Designed to help taxpayers who work or seek work when they must provide care for dependents. Okay, so you've got to put the kid in daycare. Refundable except in 2021, and based on a maximum qualifying expenditures, multiply the tax rate by the rate based on AGI. Okay. So, total amount of dependent care expenditures for the year: $8,000 for one qualifying person, $16,000 for 2 or more. $6,000. Okay, so they have that 2021 special provision, probably due to COVID. Just skip down too far here. And, expenditures for child care, whether care is provided outside or within the home. So again, if you drop your kid off at a daycare center, or you have somebody or the neighbor's kid or somebody you know comes into the house and you pay them a couple bucks to watch the kid before and after school, while you're working or looking for work, those expenditures qualify. They do not qualify if the caregiver is a dependent relative or a child of the taxpayer. Okay, so I only have one child, but if I had 2 and I paid my teenager to watch the younger child, that doesn't qualify. Okay, they would say that's a related party transaction and disallow it. Okay. I'll give you Exhibit 10. Well, that's a 2021, so you can pretty much ignore that. Example 18, Courtney paid a neighbor $10,000 to care for D-Ron, and so she could work. So that $10,000 is the amount, but I think Courtney might be in the phase out or close to it. Limit on qualifying expenditures. So she spent 10, only 8,000 qualify, and she gets a 20% credit, so $1,600 credit. What if Courtney's AGI was only 31,500? Well, the credit would be larger then. It goes from 1,600 up to 4,000 because she gets 50% of the expenditures as a credit. Next one, big one, is the education credits. There's 2 of these: the American Opportunity Credit and the Lifetime Learning, I believe the other one's called. So first thing we have to do is figure out what counts. What's eligible expenses for the American Opportunity Tax Credit includes tuition, fees, and course materials, cost of books, and other materials needed for the course of instruction at an eligible educational institution. Okay? It's applied on a per student basis. Okay? A taxpayer with 3 eligible children can claim a maximum of $2,500 for each dependent. Again, like the child care credit, It's subject to being phased out based on your AGI. So again, they intend this for a little bit of tax relief and help for average taxpayers. Upper echelon taxpayers are going to be phased out if your income's over 160,000. Well, between 80 and 90, depending on your filing status, whether you're filing separate or jointly. So 5% of the taxpayers eligible AO's American Opportunity Tax Credit is refundable. So you can actually wipe out all your tax liability plus be refunded to you as a tax refund. Key facts. I always read the key facts. And the lifetime learning credit is a non-refundable. Okay, so the American Opportunity is, the lifelong learning isn't. Lifelong learning is a little bit stricter, narrower application. Applies to the cost of tuition and fees, but not books generally. Okay, for any course of instruction to acquire or improve one's job skills. Okay, this includes the cost of professional or graduate school tuition, not limited to the first 4 years of post-secondary education. So it's not just college; it can be other things. Credit is equal to 20% of the eligible expenses, up to a maximum of $10,000 annually. Credit is for the year based on the amount paid during that year, or an academic period beginning in that year, or the first 3 months of the following year. In contrast to the American Opportunity Tax Credit, lifelong limits, credit limit applies to the taxpayer, not the dependent child or other dependent. It applies to the taxpayer themselves. And again, phase out limits. Notice between examples 21 and 22, for expenses that qualify for both American Opportunity Tax Credit and Lifetime Learning Credit, taxpayers may choose which credit to use, but they may not claim both for the same student in any given year. So there may be a situation where the taxpayer qualifies and they have a child. I would think that they could claim both, because you can't claim for yourself the same one. The taxpayer can't claim both. Earned income credit. Okay, this is to provide relief for, again, middle and lower income people that have dependent children, and this is a refundable credit. I have no problem having a person get back all the, because of their low income, get back all the money they paid into withholding, income tax withholding, but this will actually take them down below zero and give them a refund, not only of all their money, but some of my money. So again, you have to have a qualifying child, 19 or younger, unless they're a full-time student. And let's see, have one qualifying child and do not have a qualifying child for the taxpayer who lived in the United States and are not dependent. Okay, it could also, I guess, be for an older dependent over 65. That's where the amount of the credit depends on their filing status and the number of children they have. So Exhibit 811, they show where it is. When this was first instituted back in the late 1900s, people were claiming 15, 18 children. They now have a question on it for the preparer and the taxpayer that this form was done with due diligence and is true. So not only would you be subject to perjury if you did that by just signing a tax reform, you have this other form that alerts you to the fact you better not do that. And a lot of people, there was a lot of abuse with this credit, earned income credit, and you can see why. It's a refundable credit, and maximum income eligible given the number of children. So you can see the amounts are on the lower end of the earned income threshold, 14,000, or call it 15, 14,950 or lower. And the max amount of the credit anywhere from 6,000 down to 1,500. So, and again, it's a percentage. Then it's phased out as the AGI goes up, and that's easily computed. Taxes in the real world, taking a bite out of earned income tax credit abuse. IRS has special reporting requirements, Form 8867 for tax professionals filing tax years that include an earned income tax credit. Now, you should know your clients, but somebody that is filing 1,000 tax returns, you don't know if anybody had a baby or you don't know how many kids they have. But again, people would come in and give you a name and a social security number and a birth date, and that's what you need on the 1040 form. Uh, and you make these up. Then the IRS computer will check and say no such, the name and the social security doesn't match up or no such person exists, and then they got to come chasing you. So the pay preparer's income credit checklist is intended to ensure that the tax professionals use appropriate due diligence in determining the amount of and the taxpayer's eligibility for the earned income tax credit. Yeah, I want to see social security cards, government issued social security cards for those children. I want some evidence that say, yeah, you do have 3, 4, 5 kids, and their names and their birth dates, and the form has some questions there that say, yeah, you asked for this, you asked for that. Why the extra concern? Because the earned income credit is a refundable tax credit, and it's also high. The potential for fraud is quite high. Only paid tax preparers are required to complete the form. Failure to do so can end up in a $500 penalty. Yeah. Put the burden on the educated person that has more than enough work to do. Don't put it on the taxpayer. Special tax credit for 2021, we can ignore that. And again, that's COVID related. Other refundable personal credits. Portion of child tax credit, portion of the AOTC, and excess FICA withholdings. Taxes withheld on the wages. If you overpay, you get a refund. Business tax credits. Okay. We have a tax credit. I don't think the book gets into this. There is a tax credit for electric vehicles, or putting solar panels on your house, but those are somewhat limited. Designed to provide incentives for taxpayers to hire certain types of individual or participate in certain business activities. Congress provides employment tax credit to encourage people to hire people off the welfare rolls, lower the cost of government, and get them to pay taxes instead of sucking benefits out of the tax paying pool. Business tax credits are non-refundable. Okay, so you can offset income tax owed, but you can't get a refund. When the business credits other than foreign tax credit exceed the taxpayer's gross tax for the year, credits are carried back 1 year or forward 20 when the taxpayer has sufficient gross tax liability to use them. So it's a little bit different than individual. Of course, an individual could be in a business if you're a Schedule C filer. Foreign tax credits, again, there's 2 ways you can do it. You generate some or all your incomes outside the U.S. Borders, you are required to pay tax to the foreign country. You can do it in, I thought it was 2 ways, it's 3 ways. You could have a gross income and exclusion chapter, and exclude foreign earned income from U.S. taxation, and then you don't get to deduct or receive any credit for the foreign taxes paid. Secondly, you may include the foreign income in the gross income and deduct the foreign taxes paid as itemized deduction, or may include the foreign income and gross income and claim a foreign tax credit for the foreign taxes paid. Okay. Tax credit summary, Exhibit 812 does a very nice job listing them. They didn't talk about all of them. There's the residential energy credit there. Savers credit for people that are, the Congress is trying to incentivize people to invest money, especially for their golden years or retirement years. Credit for increasing research activities. Small business health insurance credit. Energy credit. And again, if you put in energy saving things, converting your lights to LEDs. I did. This room is all LED lit except for I think 1 or 2 lamps. But my ceiling lights, what do we got there? 2, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. 15 ceiling lights are all converted over to LEDs. Okay, credit application sequence. Okay. So some are refundable, some are not. So be careful on which ones you take and in which order. Keep in mind that non-refundable credits may be used to reduce a taxpayer's gross tax to zero, but not below zero. In contrast, a refundable credit may reduce a taxpayer's gross tax below zero, with any excess being refunded to the taxpayer. So when a non-refundable credit exceeds the gross tax, it reduces gross tax to zero. That's repetition, what they said. And do not carry any over. Because the tax treatment of excess credits depends on the type of the credit, it's important to identify in sequence which taxpayers apply the credits and when they have more than one. Okay, you want to do it in the following order: non-refundable credits, use those up, then the business credits, and then the refundable credits. This maximizes the chances taxpayers will receive the full benefit of the tax credits. And that is summarized in Exhibit 813 there on the bottom of page 8-35 or top of 8-36. Turn the page here. Taxpayer prepayments and filing requirements. Okay. You have to file a tax return unless you are almost penniless. Okay. For individuals, due date is April 15th, unless that falls on a holiday or weekend, then it's the next business day. Okay. They prepay our taxes with our weekly or our withholding from our paychecks, or estimated payments during the year, or credits. Okay. Estimated payments are required only if withholding is insufficient to meet the liability. And again, you have to meet we'll get into the safe harbors a little bit later here, I guess. Yeah, the safe harbors are coming up. There's some people that advocate we shouldn't have withholding, that we should all have to make estimated payments because that would make us better voters. There's some merit to that. If you have to pay, it's withheld from your paycheck. You don't see it until you do your tax return. If you got to sit down and file an estimated payment and write a check, then you see it. Not only see it, you feel it. Okay, the required withholding amounts are based on the amount you make plus your filing status. And they've got formulas. They've got the IRS has publications that tell you how much you should have. And that's how the employer figures it out. Like I said, you can always ask your employer to hold additional amounts. I do with Misericordia. They take out an extra $200-300 pay period for me, and it's still not enough. I still have to make estimated payments. That's because, well, give you a nice example. Social Security, in some cases, are taxable. If you're over $35,000, somewhere in the $35,000 range, your Social Security, some of it is taxable. Well, my wife and I both receive it. And, we have other sources of income. So our Social Security is subject to tax. Social Security gives you an option. You can have 5% withholding or 20% or 10%. I forget what it is. But my marginal tax rate is higher. There's no way they will only withhold Social Security Administration, even though it's a government organization, and they know, just like the IRS, they know there's different brackets. They will only give you 2% for withholding from your Social Security, and neither one of them. My marginal rate is higher than both the options they allow you. So go figure. I guess I figure if you make that much, you should be able to make estimated payments. Safe harbor. You have the two safe harbors there with the underpayment penalty heading, two paragraphs. At the end of the first paragraph, withholding and estimated payments and credits must equal 90% of the current year's tax liability or 100% of the previous year's tax liability. I always go with the previous year because that's a known quantity. This year, 90%, you don't know what it's going to be until you're near the end of the year. Now, it's 10% if your AGI is over $150,000. Okay. So again, they want these things divided up equally. And again, there's been some years where certain things have happened. I sold a stock or an investment and had a big capital gain. and it would throw me up a bracket. So, my first 2 or 3 quarterly estimated payments would have been for $2,000 or $3,000 a piece. And my fifth one, because I sold it in that last quarter of the year, I have to bump it up to 5 or 6 grand to cover the tax on that gain from that investment, capital gain. So again, they like it spread over evenly and over the 4 quarters. Now, again, they're 4 quarters. I always have a problem that quarterly payment is due on April 15th, the tax due date. So, more than likely I'm writing 2 big checks on that day. I have no problems with June 16th, which is 3 months later, a quarter, and then September, 3 months later, a quarter. But then they go from September 15th to January 15th. And I guess that's allow people that have, again, a lot of people will sell stock in December, either for the capital loss or capital gain, and then they give them that extra month to adjust their final quarterly payment. The software actually generates the quarterly estimated payments based on the prior year. I always adjust them because things are going to be changing. So, in fact, because it took them so long to get me my refund last year, I actually had $29 or 20 some dollars, the IRS, and they gave me a 1098 for it. So make sure I reported that one. That was the first one I put in, that they paid me interest. And again, if you underpay, they're going to charge you interest. Of course, the interest they pay you is lower than the interest they charge you. Okay. Federal short-term interest rate plus 3 percentage points. When they pay it, it will be the federal short-term interest rate. When they're paying it, when they're charging it, they're going to charge you an extra 3%. Filing requirements. Individual returns are due on April 15th for calendar year taxpayers. If you're on a fiscal year, it's the 15th of the 4th month after the end of your fiscal year. Now, you can get an extension to file your tax return, but not pay the tax. The tax has to be paid by April 15th or the first business day after April 15th. All it does is give you an extension to file the return. The form itself has a line to pay any tax owed. So if you file an extension, make sure you overpay would be the safe thing to do. You figure your taxes are going to be somewhere between $4,000 and $5,000. Send them $6,000 or $7,000 just to be safe. And when the tax return is filed 6 months later in October, or by October or earlier, you can get a refund. Again, if you file late, there's penalties based on the amount of tax owed. Late filing penalty, late payment penalty, 2 separate things. Again, the payment has to be in. The extension only applies to filing the tax return, not paying the tax owed. I had one client that never had money because it was a seasonal business, file an extension. The extension is technically invalid if the tax isn't paid with the extension. So, the tax summary. Using Courtney and Graham's here as all the stuff that went through the chapter. And you see the backside of the 1040 there, Exhibit 815 is Courtney's next tax payable. That's page 2 of the 1040 there. You can see the top of the page is the tax, and then there's the couple credits, and you come down to line 24 is total tax owed, $25,305. And then you have the payments and the credits. Federal tax withheld from her paycheck, $21,305. And she didn't have any estimated payments. She didn't have any credits. So then the difference there is $4,037. That is the tax owed. So she's going to have to write the IRS. Well, actually, write the check to the United States Treasury for $4,037. And that's the end of the chapter. Hope you enjoyed it, and you'll be hearing from me next week. Sorry I got this one out. I just had a whole bunch of exams to grade over the weekend. I try to get this out on the weekend, but so you missed 10, 12, maximum 24 hours of time to get everything done. All right. Talk to you I think we might have an exam coming up. So either we'll have the exam sent out next week or the chapter 9. Okay, I'll have to check the syllabus. I know it's close to the third exam. So